Welcome to my channel, where we help businesses navigate risk, compliance, and internal controls with clarity and confidence. Today, we're digging into something that every fast-growing company needs to get right: enterprise risk management, or ERM. ERM is often seen as a defensive exercise, but in reality, the companies that do it well are using ERM to do more than protect value. They're using it to create value by making faster, more informed, strategic decisions across finance, HR, operations, and technology. Today, we're going to break down what true enterprise-wide risk management looks like, the role of risk appetite, tolerance, and treatment, and how forward-looking companies are using ERM to navigate uncertainty and grow with confidence. Let's start with the basic truth. Risk doesn't respect department boundaries. If your finance team is modeling interest rate exposure, but your HR team isn't tracking retention trends, and your IT team is managing cyber risk without visibility into vendor dependencies, you're flying blind in different directions. A strong ERM program will bring all of that together, and it connects finance, where risks include tariffs, FX volatility, and budget swings. HR, where compliance, retention, and labor law risk evolve fast. Operations, where vendor failures, supply chain lags, and regulatory shifts can create bottlenecks. Technology, where threats like data breaches, AI ethics, and system failures dominate the landscape. And it's not just about internal risk. True ERM includes external forces, emerging trends, competitor shifts, global instability, and regulatory change. In short, ERM is the only way to understand enterprise exposure in a unified and strategic way. One company that has been a model for risk-aligned growth is Lego. Rather than viewing risk management as a barrier, Lego integrated it directly into its business planning processes. They tied risk ownership to every major product launch, ran simulations for geographic expansion, and even used risk modeling to guide pricing strategy. This has allowed them to take on bigger, faster, riskier initiatives because they had their framework in place to manage those risks intelligently. It's a perfect example of ERM as an enabler, not an obstacle. Let's talk about three concepts that sit at the heart of good ERM: risk appetite, risk tolerance, and risk treatment. Risk appetite is the amount and type of risk your company is willing to accept in the pursuit of its goals. Think of it as the strategic ceiling. For example, a SaaS company might have a high appetite for product innovation, but a low appetite for service disruption or customer churn. Appetite is set at the leadership level. It shapes your decisions around investments, expansion, and even mergers and acquisition. Risk tolerance is the acceptable variation within that appetite. If your appetite allows a risky new launch, but your tolerance might say, we're okay with a 5% drop in revenue, but not 10. Anything outside that range triggers review, mitigation, or a hard stop. This is the operational line in the sand. It ensures your teams know when to escalate and when to act. Risk treatment is where the rubber meets the road. It's how you actually manage the risk. And you've got four options: avoid it by walking away, mitigate it, reduce the likelihood or impact, transfer it through insurance or contracts, accept it with full visibility and control. These concepts, appetite, tolerance, treatment, give companies a decision-making framework for both everyday issues and board-level strategy. Let's take a few examples. Finance might have a medium appetite for an FX risk, a 3% tolerance, and a treatment plan that includes hedging and budget flexibility. HR might have a low appetite for attrition, a 10% tolerance, and treatments like stay interviews and leadership training. IT may have a high accept risk in AI experimentation, but have zero tolerance for data leakage. So treatment includes DLP, logging, and access reviews. Operations might tolerate up to 7 days supply chain disruption and mitigate that through diversified vendors or robust SLA. This level of clarity empowers leadership to take calculated risks that align with strategy and not fight against it. When done right, ERM doesn't slow down the business, it gives it license to grow. It provides guardrails that enable speed, clarity, and agility. It builds trust with your board, investors, and regulators, and it allows your teams to respond, not react, to change. It starts with defining risk appetite, setting tolerances, and building structured treatment plans that scale with your business. At the Audit Advantage Group, we help organizations implement ERM programs that are practical, integrated, and growth-ready. If you're ready to unify your finance, HR, tech, and operations team under a single risk framework, or if you're struggling to define your risk appetite and tolerance, we're here to help. Until next time, my friends, stay bold, stay focused, and lead with confidence.